Welcome to our half-yearly investor update for the Totus Alpha strategy. I'm Ben McGarry, founder and co-portfolio manager of the Totus Alpha strategy. I'm joined today by Tim Warner, my co-PM, and Jack Cherry. Together we will discuss how our investment approach differs to other managers, provide a summary of recent performance, and discuss some of our key portfolio ideas. Before we proceed, please note that the information provided in this update is for general information only and is not intended to provide you with financial advice. It has been prepared without considering your objectives, financial situation, or needs. Totus is an absolute return manager based in Sydney. We're committed to preserving and growing investors' capital through all market conditions. Our team's personal investment in our Alpha strategy aligns our interests with you. Our Alpha strategy aims to deliver consistent positive returns regardless of market conditions, utilising a flexible approach across sectors and market capitalisations. We are fundamental investors. So what does that mean? It means we approach equity investing as though we are business owners. Before buying a stock, we ask ourselves if we would be comfortable owning 100% of the business if it was a private company and we couldn't sell. It means we evaluate things like business sustainability, valuation, payback periods, and risks. Now, there are a whole bunch of investors out there who don't approach investing like we do. These are the passive investors, the momentum investors, the speculators, the meme stock crowd, the growth at any price, and the never sell crowd. To these investors, a stock is just a ticker that goes up and down on a screen. These investors don't care what a company does, if it's profitable, its industry structure, earnings quality, or anything about its actual operations. To them, big is better than profitable, expensive is better than cheap, and story is more important than substance. This is both the challenge and the opportunity of long-short investing in 2024. If you invest with Totus, you are making a bet that fundamentals will matter eventually. If you think that they won't, that valuations don't matter, that multiples can expand forever, and that governments and central banks have now complete control over the business cycle and that downturns are a relic of the past, this probably isn't the investment for you. If this time isn't different, if at some point valuation, earnings, and returns matter for stock markets, then our Alpha strategy should continue to do okay over time. The net result of our approach has been a strong track record of performance over 12.5 years, delivered with minimal market risk. Turning now to our investment process. Today I'm going to talk about how we use themes or buckets of alpha to narrow down our investable universe, and some of the attributes we look for when we analyse a company bottom up. With limited time and resources as a team, we use themes to try to focus our research effort. These themes can be very broad and long-term in nature, or they could be quite short-term and industry-specific. Some themes come along and play out over a finite period, and others are quirks or features that are always present in markets if you look hard enough in the right places. We've highlighted a few current themes in the portfolio on this slide. Some companies are exposed to multiple themes at the same time, and there is a degree of judgment involved in deciding which stock has the best or most concentrated exposure to a particular theme. Themes serve as a guide for us and help us with the pattern recognition that makes our investment process repeatable over time. Last webinar, we talked about return on invested capital as a good, simple measure of business quality. This slide goes through some other attributes we look for in companies when we analyse them. These attributes are a mixture of quantitative and qualitative factors that often mirror each other. For example, if earnings growth is something we look for in longs, lack of growth might be something attractive to us in a short position. Companies gaining market share tend to grow earnings faster than those losing market share. Most of these attributes are present and can be assessed and measured in all listed companies regardless of industry sector and market capitalisation.
Since 2012, the Totus Alpha strategy has returned 13.2% per annum net of all fees. We have delivered an equity plus return whilst taking on significantly less equity risk, averaging a low net exposure through the cycle of 30 to 40% and a negative beta to markets. This minimal correlation to markets is a function of the portfolio's composition, which looks nothing like any market index. Consequently, in the short term, this can lead to periods of notable underperformance compared to equity markets. Now, we are absolute return investors and do not judge our success relative to the market in the short term. However, looking at the last 12 months, we note that performance has been lackluster, with the strategy up only 1%, while equity markets have gone from strength to strength. Now, our performance has been driven by two main factors. Firstly, it has been a very difficult environment for short selling. Despite being correct on the fundamentals, we underestimated the extent of valuation re-ratings, particularly in the big four banks and major Australian retailers. Earnings have been stagnant or declining, but the stocks have experienced valuation increases of 40 to 50% over the past year. Secondly, our significant long exposure to met coal has been a major drag this year. We based our investment on a long-term supply-demand imbalance due to underinvestment in the sector. In July, we increased our position following a supply disruption that affected 2 to 3% of global production. Unfortunately, subsequent weakness in China and negative sentiment in the steel market led to a sharp decline in met coal prices, down over 30% in a short period of time. We have since reduced our position to manage risk, but remain open to re-adding exposure when the demand environment improves. Despite the short-term setbacks, our long-term investment in this theme has generated substantial cumulative returns, a reminder that the outsized returns are made over years, not months. Through this difficult period, we have stuck to our process, consistently delivering returns that remain uncorrelated with the broader market. Now, this approach has provided substantial diversification benefits for investors with long-biased portfolios, enhancing the quality of their returns by reducing volatility and limiting downside risk without sacrificing overall returns. Over the past 3 years, we have delivered a return in line with equities, but performed at very different times to the overall market. Now, to illustrate this benefit, if you had an equal allocation to the Alpha strategy and to the ASX 300 Accum index in your portfolio, you would have delivered the same return, but with nearly half the volatility and 1/3 of the downside. This has been consistent with the long-term return profile since the fund's inception in 2012 and highlights the benefit of holding for the long term within a broader portfolio.
As you would all be aware, the investment landscape has been dominated as of late by the Magnificent Seven. These mega-cap US tech companies have been at the forefront of the AI investment curve via both public cloud infrastructure, search, and digital advertising. Having owned Meta, Google, Microsoft, Amazon, and Apple in varying sizes over the life of the fund, these are businesses we follow quite closely and admire greatly. For over a decade now, these businesses have had undisputed market leadership, strong organic growth, high returns on capital, excellent capital management, and strong thematic tailwinds, most of which continue to this day. Despite seeing early signs of an acceleration in public cloud growth and improvements in recommendation engines for digital advertisers, we believe the most important dynamic of the AI investment thematic is the exploding CapEx budgets of these mega cap companies. Historically, these businesses were quite asset light, with little capital investment required for an incremental Microsoft Office or Instagram user. This resulted in extremely strong cash generation and a steady stream of capital returns for shareholders. Fast forward to today, and that dynamic is shifting. The chart on screen shows the capital expenditure expectations for these mega cap companies out to FY26. with capital expenditures growing over 40% cumulatively year on year in FY24, this ramp up in capital spend is expected to continue to close to $240 billion by FY26, an over $100 billion increase versus FY23 for the cohort pictured on the below chart. The primary beneficiary of this spend to date has been Nvidia, with GPU demand exploding as these companies seek to rapidly increase cloud capacity for both internal application usage as well as public cloud supply. Whilst earnings growth has continued for these companies, the rapid acceleration in capital spend will take capital spend as a percentage of operating cash flows to record levels, which, given free cash flow is operating cash flow minus capital expenditure, will reduce free cash flow margins and in turn the funds left over for capital returns to shareholders. AI may or may not be the greatest productivity and profit opportunity of our lifetimes. The jury is still out on that one, in our view. The issue is that megacap tech CEOs see it as both an existential threat and a generational opportunity, and therefore a force to go big. Our main concerns revolve around what is the actual expected return on this acceleration in investment capital, and how patient will investors actually be waiting for these returns? Comments from Sundar Pichai, the CEO of Google, on their earnings call in Q2 highlighted the ROIC uncertainty perfectly. When asked about the acceleration in capital spend for AI and if the industry is actually overspending, Pichai noted, quote, "The risk of underinvesting is dramatically greater than the risk of overinvesting for us here, even in scenarios if it turns out that we are overinvesting," end quote. Adding to the denominator in the return on invested capital equation is easy. It is the numerator, the earnings, which is harder. The chart on screen shows the return on invested capital for these businesses as of the latest quarterly reports in June. Cost discipline, increasing cloud spend, has driven material margin expansion and earnings growth for the subset, which is reflected within the ROICs of these businesses. Combined with sizable multiple expansion, this phenomenon has fueled the AI rally to date, with the market extrapolating this trend years into the future. We track return on invested capital closely, and we know that invested capital is set to increase materially in the coming quarters without what we believe to be a clear line of sight on the actual return. Given this dynamic looks to be accelerating, we've become more cautious on these positions within the portfolio and progressively degrossed, awaiting greater clarity on the return on this spend. Last webinar, we discussed why we like online real estate portals and noted that we'd invested in Rightmove, the market leader in UK property portals. This month, we have had realestate.com launch an offer for Rightmove. REA highlighted that they see it as a compelling opportunity to create a global and diversified property company with #1 market positions in both the UK and Australia. Whilst the synergies from an operational perspective may be limited, it is what REA did not mention within its market statement: the significant divergence in valuation between these two companies, which makes this deal compelling in terms of earnings accretion to REA. The chart on screen shows just how large this valuation gap is, despite both companies having similar market positions and financial attributes. Long term, we see this as a great deal for REA. The UK has a housing market over 2.5 times the size of Australia's, but Rightmove has 40% lower revenues than REA's core Australian listings product. If over time, REA can successfully move Rightmove from an agent pay to a vendor pay model, there should be significant upside to earnings for Rightmove. We've increased our positions in both Rightmove and REA this month.
In summary, it's been a difficult period for our style of investing recently, with multiples expanding as investors look through short-term weakness in earnings in the expectation that rate cuts will support valuations and push stocks higher. This, of course, is the Goldilocks scenario that assumes any weakness in the economy that central banks are reacting to is of the soft or no landing kind. In recent weeks, we've seen bond yields fall aggressively as debt investors seek safety, which may indicate that a harder landing is inbound. What if the bond market is right? As opposed to 6 months ago where we saw risks as pretty evenly balanced, we do see some risks on the horizon for equities at this time. One is, as Jack discussed, a potential air pocket for big tech earnings as they invest aggressively ahead of expected AI monetization. Another is the volatility we are starting to see in Japan as inflation and interest rates start to lift off, which, given they are one of the world's largest foreign investors, could have a knock-on effect for equities globally. The ongoing weakness in China is potentially a big deal for our market. Recently, we've seen broad-based weakness in economic bellwether commodities like steel, oil, and copper. This is not bullish and may signal deeper issues for the global economy that are not currently reflected in historically expensive developed market equities. Finally, we have the per capita recession currently underway in Australia, which is squeezing consumers and companies alike with higher cost of living, pressure on margins, and an increasingly investor-unfriendly regulatory climate at state and federal levels. As always, if you have any questions about what we discussed today or would like more information about our alpha strategy, please don't hesitate to get in touch. Thank you.